Woo! Lots of fun stuff going on. Welcome to my market update. I'm going to try to keep it brief today. Basically, there's a lot of fun things going on. There's a lot of news out that is cause to be excited. A lot of things happening in the market that we want to be taking note of, that we want to monitor, that we want to pay attention to really make those educated predictions in terms of where we're headed. So whatever your real estate goals are, buying, selling, investing, hopefully I can give you a little bit of an idea of the landscape, and you can make your decisions accordingly. So let me shrink my big head. Basically, rates held, okay? We know interest rates held. I'm sure you've heard it. Sixth rate hold in a row. Bank of Canada overnight rate is holding at 5%. Now, this is great. No change. It's not going to immediately have a change or an effect on the market, but the Bank of Canada signaled the June rate cuts. Okay, we know the economists' popular consensus is 4 rate cuts in 2024, which are most likely going to happen in the latter half of the year. Inflation numbers are working their way down. Gas prices are still kind of a sticking point, and then Canada being as unique as we are, we include that interest cost within our CPI. We're actually one of the only countries that does that. So if you apply those numbers, our inflation, the actual value of our inflation, when we remove the interest portion contributing to inflation, we are close to that 2% target. Okay, so the next announcement is June 5th. Really excited for that. Let's see what happens on June 5th. At this point, I'm 50-50 in terms of another hold or another cut. I'm 50-50, but hey, who knows? There's a lot more rate cuts than that. These are just the big ones that I'm really paying attention to that I think are going to have some impact on our market, okay? Because September, we're getting into that seasonality. December is going to prep us for the 2025 market, but there are more announcement dates. Those are in your email. Now, this is kind of what we want to analyze or what we want to see, okay? So the inflation rate, we peaked. We know we peaked. We know why we peaked. We know why inflation ran rampant throughout 2022 or the start of 2022, simply because there was money everywhere. It was easy to obtain money, and money was still cheap. Okay, as soon as we started to increase interest rates, we saw that inflation from the just north of 8% high start to work its way down, start to tick downward. Okay, now what does inflation do? Again, to remind you, inflation erodes cash. Inflation erodes the value of a dollar. So it's actually a great time to take on debt when inflation is high because it's eroding your debt. Okay, the fact that inflation is working its way down is better for the overall economy, working toward that soft landing, so to speak. The big point I'd like to make here, you can see there's it looks like there's a symbiotic relationship here, but really there's an inverse relationship here between the Bank of Canada's interest rate and inflation. Now, the big point I want to make is employment. Employment numbers have started to tick down. Okay, so unemployment is ticking up, which again, not in a scary position. When you really break it down, service sector, some of the struggling sectors of the economy, but the good jobs, the high-paying jobs, the home buyers and home sellers are employed. But we have to see a little bit of that unemployment ticking up. Unfortunately, it's the nature of the beast to be able to justify a rate cut. Okay, so as we see inflation work its way down, sorry, I said inverse relationship. There's actually a positive correlation between inflation and interest rates. As inflation comes down, interest rates come down. Sorry, scratch that. I'm not going to start the video over, but scratch that inverse relationship. But what we want to see is we want to see this trend continuing, okay? So you can see the Bank of Canada interest rate is still significantly higher when you look at January 2024. I don't know if you can see my mouse on this thing, but over here. As the annual inflation rate works its way down, we can safely assume Bank of Canada's interest rate is going to follow. And what do we know, right? When it rains, we use an umbrella. When we see a red light, we stop. There's certain indicators that we know that are predictable, okay? When inflation comes down, rates are going to come down. When rates come down, asset prices will increase. The numbers are, for every 1% decrease in interest rates, Bank of Canada interest rates, it increases purchasing power by 12%. So by the end of the year, we can confidently assume that buyers' purchasing power is going to be amplified by 12%, pointing to a very significant uptick in asset prices. Now, this won't happen overnight, but over the next, 24 through 26, we will see asset prices appreciating versus decline. Okay, so the lights at the end of the tunnel, the worst is definitely behind us. We can confidently say that, assuming there's no more black swan events or force majeure dealings. Okay, now economic indicators. Where can I put myself here? I'll just cover the title. Who cares? So real GDP growth, we're actually seeing that increase, which that's steady. A 1% increase, that's cool. That's fine. That's standard. I'm happy with that. It's nice to see our output is increasing, but it's not crazy growth to show that we're spending a ton of money contributing more to inflation. So I'm okay with that. The employment growth in Toronto specifically is great. Okay, Toronto core. Unemployment rate is the big one that you want to look at here. Okay, the unemployment rate, so the employment growth means job creation. Unemployment rate is the percentage of the population that's unemployed. Doesn't mean we have 7.1% unemployment, but the growth has been a 7.1% increase. So it's a small increase to a smallish number, but as much as that may suck, or you may say, oh, that people losing their jobs, it's actually a positive because it's going to provide us the opportunity to have that soft landing. There's jobs available. There's job postings everywhere. It's actually very difficult to find good quality employees. Now, we've had 2 consecutive months where I'm looking very forward to April's numbers, but 2 consecutive months of sub 3% inflation, which is great, heading into where we want to head into. Prime rate's a little nuts at 7.2. Excited to see that work its way down. We know the overnight rate is 5. Little fun fact for you, Canadian banks don't borrow from the Bank of Canada for the majority. Okay, they borrow overseas, majority being Chinese banks and Indian banks. There's 5-year fixed rates at 4.9%. 4.9%, lower than the overnight rate. So don't let this intimidate you. Okay, we're seeing variable rates obviously a little bit higher. When the prospectus, it's actually a good sign. It's almost like an indicator. When variable is higher than fixed, it means that the outlook is very positive. If you think back during COVID, variable was lower than fixed. It means that the outlook is negative. We know rates are going to go up. Okay, that's kind of the idea. So when variable rates are higher than fixed rates at the bank level, it means that they're very confident that the interest rates will work their way down. Just a little side note. Okay, so this is an interesting thing to look at. We're seeing a 1.32% increase in average price, in asset price from TREB from March 23 to March 24. Stagnant year. It's been stagnant because there hasn't been much real change. There hasn't been much substance in terms of change in the economy. We've just been cruising. We've just been avoiding disaster. Okay, sales activity, we actually saw a big decline. Slowest sales in March 24 since March 09. Slowest spring market we've had. But we can confidently assume that transaction volume is going to pick up. And I've said before, you sell one Ferrari or you sell 10,000 Ferraris, it's still a Ferrari. Toronto real estate is still Ferraris. The pricing hasn't changed. I don't care too much about transaction volume, but I can safely assume the volume's coming back based on the economic outlook when we compare inflation heading into interest rates. Okay, so some relevant news that you may want to look at. This one I put here because it's being talked about. I really don't care about this. Okay, if you're making Canadian dollars and you're spending Canadian dollars, who cares? You're in a bubble. Okay, you're in a bubble. And economy-wise, not a massive effect. As our interest rates work their way down, we will see a bit of a gap between us and the United States. It'll recover. I'm confident by 2026 we're going to be very close to par. That's my own personal economic outlook based on the trends I'm observing. But we're seeing this in the news. It's relevant news, but it's not relevant information. Okay, so I want you to take note of that. I don't care about Canadian dollars. I make money in Canadian dollars. I spend money in Canadian dollars. Sure, if I want to go down to Florida for a month, costs me a little bit more. Maybe I go to BC or I go out east instead. I don't know. But I'm making money in Canadian dollars. I'm spending money. I'm buying homes in Canadian dollars. And foreign buyers, they're not coming here anyways. They can't, right? Some buyers, some investors are earning an income in the U.S., spending that money here, enjoying the spread. Now, home prices, there's an array of outlooks, okay? But this is kind of the average. Everywhere from, I'm seeing 4% up to about 8% increase. We're very confident, or again, it's all based on prediction, crystal ball, what we can observe and interpret now, but peak levels in 2026. So we know we're working our way upward, meaning this is kind of the bottom. Your time for a buyer, for an investor is running out. Now, there's a lot going on. Government's investing a ton of money in terms of affordability. A lot of it is political play. There's really not much juice. There's really not much substance to a lot of this stuff. Okay, a lot of it is political plays. The RRSP withdrawal limit increasing is great for first-time buyers. It helps. I mean, there's other measures they should be putting into place, like eliminating land transfer tax for first-time buyers. That would help, but hey, what do I know, right? There's some other things you should know. The Renters' Bill of Rights, potentially coming into effect. Just announced yesterday was the federal budget. Okay, so that's interesting. I didn't put it in the slides. I didn't have time to put it in the slides. I want to get this out to you guys. Big thing there is capital gains tax over 250,000 is increasing to 2/3 potential. Okay, not confirmed, but potentially any capital gains over 250,000 is going to be increased to 2/3 taxable. Okay, not a big deal. Still the lowest tax rate on invested income. Right? We like to make a big deal of these things, but not going to stop me. The only thing it might do is investors may hold their properties a little bit longer. Other than that, nothing crazy for my market. 30-year AMs for first-time buyers on mortgages on new homes. Not a big deal. They're making it a big deal. Not a big deal. You can always get a 30-year amortization on a home that you put 20% down on. Now they're saying any new builds, any pre-construction that you put less than 20% down on, you can qualify for a 30-year AM. But most pre-cons, most pre-builds require you to put 20% down. So not that big a deal. Okay? So basically, I'll put myself right in there. Let's do this. I am the crystal ball. I think I've done that before. This is cool. I feel like, what's that guy? Zortex. Remember Dave and Buster's? You put your toonie in and he reads your fortune, the fortune teller guy. Anyway, my predictions, bullish. I think we're going to work from the core outward. So again, if Toronto goes up 8%, GTA may go up 6 or 8 or 7. As we go further out, we'll increase less. Density. We have to get back to kind of those standard models that we were observing pre-COVID. Okay, during COVID, things went crazy, right? People wanted land, wanted space. Now we're seeing density come back, the value of distance and time, people wanting to live in the core. Pre-construction's offering phenomenal incentives right now. I would highly encourage you guys, if you're thinking of investing, consider pre-construction. The incentives are great. You're deferring any kind of mortgage payment. So by 2026, 27, 28, there's even a project 2030 occupancy. By then, rates will normalize. You're going to be living the dream when it comes time to qualify for a mortgage. And, you can save up in the meantime. Less pressure, not dealing with tenants or anything to that effect. If you are looking to make a move, if you're upsizing, great time to do so. That spread is still low, or as low as it'll be, as compressed. As the market starts to appreciate, I don't know if this makes sense, my hands, but when the market appreciates, everything appreciates, but that gap increases. Hope that makes sense. So the gap between asset classes will increase as we move forward. What else can I tell you? I'm very bullish. I mean, if you're thinking of making a move, moving up an asset class or getting into the market for the first time or investing, you've got a really wicked window here. I'm practicing what I preach. A lot of my team is practicing what we preach. They're buying pre-cons. They're buying investment properties. I'm building a custom house right now. Doing the best we can to deploy as much capital as I can in the market. This is, I truly believe, a generational opportunity coming out of the pandemic to catch us on an uptick, on a wicked appreciation wave. Government can't slow the market. It can't. Okay. Supply issue we cannot solve. It's an impossibility to solve the supply issue. The supply-demand spread, especially in Toronto core. We can solve it in Brantford. We can solve it in Bolton. We can solve it in Oshawa. And we can solve it in Collingwood. We can't solve it in Toronto core and kind of that periphery of the GTA. The land's just not there. The developers just don't have the same sophistication. There's a very small pool of them that do to build at this level. And that's kind of where we're at. So anyway, those are my takes on the market. That's my analysis. Hope you enjoyed. Sorry, I always go longer than I think I will. I try to keep this under 5 minutes, but it's just too much to say. So hope you enjoyed. If you have any feedback, I'd love to hear your feedback. If there's anything you have questions on, send it to us. Send us your feedback. And yeah, guys, have a great day. Have a great summer. What is it today? April 17th, heading into the spring, heading into the summer. Super excited. So we're excited to see where the real estate market goes. As always, we're here for your questions. We have the answers to your questions, and we love your referrals. So please, if you got friends and family, make sure they're well protected out there. There's a lot of agents and not a lot of qualified agents. So if you've got friends, family, relatives, coworkers, whatever, thinking of buying, selling, you hear them talking about it, please share our name. Feel free to give them my cell phone number directly. We've got the team, we've got the scale to service all your business. Okay, so thank you. And as always, questions, give me a ring. Have a great day, guys. Thanks for listening.